Good morning. You are watching a live market outlook for Tuesday, 6th of December 2011, prepared by Windsor Brokers. Positive sentiment that came yesterday after the meeting of Merkel and Sarkozy in Frankfurt when they agreed steps to improve the current situation and to tell the world that Europe is in the rule and that is ready and capable of paying back their debts, reduce their deficits, and restore the growth. Came again under the black clouds after the S&P warned it might carry out an unprecedented mass downgrade of Eurozone countries if EU leaders fail to deliver a convincing agreement on how to solve the region debt crisis in a summit on Friday. This comes as a cold water over everyone, and the markets came under immediate pressure as some positive tone seen yesterday has been again raised, and now euro is heading lower, losing some important supports, and we'll keep following it to see what will be the next developments. The S&P told the governments it would conclude its review as soon as possible after the summit, making clear that it wanted to see political as well as financial solutions. It highlighted continuing disagreement among European policy makers on how to tackle the immediate market confidence crisis and longer term how to ensure a greater economic, financial and fiscal convergence among Eurozone members. In its statement, it said that systematic stresses in the Eurozone have risen in recent weeks to the extent that they now put downward pressure on the credit standing of the Eurozone as a whole. The S&P also stated that a rating could be lowered by one notch for Austria, Belgium, Finland, Germany and Netherlands, as well as Luxembourg, and by up to 2 notches for the remaining 9 placed under review, including currently AAA rated France. Cyprus was already on downgrade watch, and Greece already has a junk CC rating. The confidence that European leaders will come up with a credible plan lifted world stocks and currencies on Monday, but as I mentioned, it was quite short-lived, and we are going to watch now on 9th of December. There is a Eurozone summit where will be the key decision to be or not to be, actually, as now additional pressure comes from the rating agency, and the European leaders must come with some workable solution to come out. Otherwise, we might see the quite disastrous scenario. Brief look to today's calendar before we go to the technical part of our report. The Australian Central Bank decreased their interest rates as expected from 4.5% to 4.25% on their today's meeting. Still to come today at approximately 2 minutes, the Swiss CPI monthly that is expected to go up by 0.1% compared to minus 0.1% previous month released. Eurozone quarterly GDP revised is due at 10 o'clock GMT and is expected to stay unchanged at 0.2%. German factory orders for November due at 11 o'clock GMT are expected to show healthy growth by 0.9% compared to previous month release of minus 4.3%. Also from across the ocean, Bank of Canada, Canadian building permits monthly are due at 13:30 GMT, and today's forecast is 2.3% raise compared to last month release of minus 4.9%. Bank of Canada is due to release their rate decision at 1400 hours GMT, and they are expected to stay unchanged at 1%. This was all from today's calendar. Let's now take a look on the markets, as you are all looking for the further action of the currencies and commodities. As we can see on euro on the hourly chart, the studies are again negative. The price is holding below the 20 days simple moving average, our main indicator on the hourly chart, as the pair remains in decline from 135.47, the last Friday's peak. The positive sentiment that was gained after the joint intervention of central banks last week has failed actually to extend gains to our next strong barrier at 136 zone, as the gains stalled at 135.47, and then additional pressure came after the US jobs data on Friday that additionally pushed the currency pair lower. Some improvement was seen yesterday on the meeting, after the meeting of the Eurozone leaders, and some positive sentiment that came out of this, with again pressure from fundamentals again coming from this latest release of S&P. The technical outlook for euro remains still negative, as the pair is in the short-term downtrend, and we lost 133.60 important support, and broke below 61.8% retracement of the corrective bounce from 132.11 up to 135.47. That further weakens the tone. Immediate target is now at 133.20 zone, which is the main trendline support drawn of 132.11, below which would further weaken the near-term tone and possibly open a way for test of 133 as psychological and figure support, and then we have 132.58 higher low of 30th of November, ahead of possible full retracement and the test of 132.11 low. Some relief might be seen on the oversold hourly studies that might trigger a corrective bounce, with the 133.84 as immediate support, immediate resistance, pardon, and the 134 zone, where also stands the 20 days moving average. At this stage, this area should cap the upside attempts. Possible extension up to 134.20 is not ruled out. However, only regain of 134.85 and the 135 zone would signal higher low and the possible and refocus the upside levels at 135.47. For now, the near-term negative tone persists, and the focus is on 133.30 and 133.00 as immediate targets. As I mentioned, some delay might be seen on the corrective bounce, as the hourly studies are now entering the oversold territory. The British pound against dollar also comes under pressure, as the pullback from 157.77 30th of November low dipped down to 155.76. This was the low of last Friday, where we have seen the basing attempt. A recovery attempt higher was capped by the trend line, bear trend line of 157.77, with immediate weakening now threatening again 155.76 low, loss of which would be signaling a further extension lower and a possible test of 155.25 and 155.00, our next targets, where also comes the 61.8 Fibonacci retracement. First comes 61.8 Fibonacci retracement at 155.57, and then 155.25 higher low of 30th of November, as well as 155 as a figure support. The 4-hour studies are now attempting below the MACD is attempting below the center line and is in negative mode, while the pair has lost the momentum. 20 days moving average at 156.60 caps the upside for now, as well as a broken trend line of 154.22 low, currently standing at 156.56. On the upside, regain of the immediate resistance also at 156.51. Break above 157, where also comes the bear trend line of 157.77 might signal some recovery. However, clearance of 157.15, 157.25 previous highs is required to signal bottoming at zone just below 156 and refocus levels at 157.77 and possibly to test 158, 158.80 on a break. Dollar yen lost traction again after unsuccessful attempt through our initial barrier at 78.00 as it was hit overnight. 78.10 high was hit overnight, and then steady easing brought the pair down towards 77.70 zone, where there is currently basing attempt just above the main bull trend line drawn of 76.56 low. Ability to hold the gains, to hold losses above these levels might keep hopes for a fresh attack higher in alive. We need to see clearance of 77.78, which is the hourly 20 days moving average, 77.88, and then 78.00 as our initial barrier. Also is the trend line resistance. A break above which to refocus 78.27 and 78.44 previous highs and resume the broader uptrend from 76.56 low of 18th of November. On the downside, 77.67 today's low is offering initial support ahead of 77.61. So 77.60-70 zone is now our initial support, ahead of 77.50, which marks the 50% Fibonacci retracement of end of October post-intervention rally from 75.56 up to 79.52, below which might refocus levels towards 77.28, the low of 30th of November, and 77.00 as the key support on the downside. Dollar Swiss is back to strength, continues to channel higher after making a bottom at 90.60, 64, 67, 69 zone, and a recent break above 92 barrier and 92.40 previous highs. 92.40, 50 previous highs is now stretching higher. 92.94 was seen so far, is just ahead of 93 barrier, and then a possible extension higher towards 93.13 previous high of 6th of October, and 93.28 high of 25th of November. That might confirm the end of the corrective, near-term corrective phase from 93.28 down to 90.64, and resume the broader uptrend from a historical low of 70.67, and to look for a test of 94.50 on a break. There was fear of posting a double top as seen on the daily chart, 93.38 and 93.13 and 93.38, as the pair briefly broke below the main bull trend line drawn from 70.67 low. However, now the pair is regaining strength, and the break above 93.00 is to confirm an end of the corrective pullback and resume the gains higher. The studies on the 4-hour and hourly charts are positive and supportive, and the only loss of support at 92 zone, where also stands 20 days moving average, might delay immediate bulls, with the break below trendline support at 91.86 and the higher low at 91.63 to confirm the temporary top. Commodities came under pressure again after the latest news came from S&P. As we can see, the gold is again under pressure after hitting a fresh high at 1762.90 last Friday, with steady decline now threatening again our key support at 1700. 1708 level was seen so far. We need to hold above 1700 in order to maintain the recent positive action from 1666 low of 21st of November. However, the 4-hour studies are now losing momentum and breaking below their midlines, with the 20 days moving average currently maintaining pointing lower and maintaining the recent decline. Only break on the upside above 1750, 1755, where is the bull trend line, is would provide relief and signal higher low and the resumption of the short-term uptrend from 1666. Loss of 1700 support would be risky and might confirm the lower top at 1762.90 and turn the focus down towards 1683, where is the near-term bull trend line currently standing, and then higher low at 1671 ahead of possible retest of 1666. The crude oil is also in the corrective mode. However, the broader uptrend from 95 strong support zone is still in play, as long as trend line drawn from the lows currently standing at 100 zone is holding the downside. The 4-hour studies are still keeping the positive outlook but pointing lower, and we might see some further reversal ahead of fresh strength with the 38.2 Fibonacci retracement currently standing at 99.58, seen next on a break below 100. 100 is our main support for now. On the upside, regain of initially 10170, the previous high of 30th of November, is to open a retest of overnight's high at 102.42. Overall outlook for crude oil still holds the positive structure, while 200 days moving average currently at 95.97 holds. We have strong support zone at 95.96, where the recent dip from 103.35 was contained, and while holding above these levels, the short-term bullish structure remains intact and looks for test 103.35, above which to open 104, 104.50, and in the medium term, not ruled out a retest of 114.80 high of the year posted 1st of May 2011, in case of a clear break above 104.56, the last strong obstacle on the way towards 114.80. Also, a lot depends now on the fundamentals that are main drivers of the market in the past couple of weeks. So we'll be watching, as well as technicals, we'll be watching the fundamentals that are keeping the pressure or giving a boost to the commodities and the currencies.